Singapore Exchange has saw its share price drop by 15% at the end of May and has not recovered since. What happened, and is it time to buy SGX? Let's find out. SGX is the most profitable business on Singapore Exchange. It has an operating margin of 51% back in 2019. Although we mainly know SGX as an equity exchange, its main business is actually in derivative. It has three main business segments right now: market data and connectivity, equities and fixed income, and derivative. Its equity business has been struggling for a few years now. Back in 2019, it actually saw a 15% drop in this segment of business. The equity exchange has gone through multiple challenges, such as the bad reputation of S-Chip, mainland Chinese company listed on SGX. They have also gone through the penny stock crash a few years ago, and most recently, a string of high-profile delisting has really dampened investors' interest in the exchange. However, its derivative business has been growing strongly, offsetting some of the losses from the equity business. In 2019, the derivative business actually grew 35%. So when the news broke in May that SGX is not renewing its licensing agreement with index provider MSCI, the market is not happy. From news report, SGX has stated that they expect a 10 to 15% drop in their net income from the loss of MSCI indices. In 2019, the bulk of their derivative volume is actually only made up of 4 derivative contracts. They are the FTSE China A50 futures, the Nikkei futures, the Nifty futures, and the MSCI Taiwan futures. Unfortunately, all MSCI contracts except those Singapore-related ones will be cancelled by February 2021. This is a big blow to SGX, but there is an even greater risk in the near future. This is because MSCI has moved the license to Hong Kong Exchange and Clearing, a key rival to SGX in the region. And Hong Kong Exchange has announced that it will launch 37 contracts based on the MSCI agreement. And that includes the MSCI China A Index futures, which could be a direct competition to SGX A50 contracts. The China A50 futures has contributed more than 50% of the total volume traded on derivative on SGX. It is also a key growth driver for the derivative business of SGX over the past few years. So SGX really need to defend this at all costs. However, SGX is not sitting still and has been trying to grow and diversify its derivative business. For one, they have created their own line of indices called IH back in 2015. They have also acquired the BALTIC exchange back in 2016. BALTIC exchange owned the BALTIC Dry Index, which is a key shipping and trade index. Although SGX is not in the best place compared to a year ago, it is still one of the strongest company on Singapore Exchange. It has a highly profitable business and a great balance sheet. Nevertheless, the risk of SGX as a stock has definitely increased with the loss of MSCI indices going to Hong Kong Exchange. And in my opinion, the drop in its share price is quite warranted. Going forward, SGX needs to show that it can regain the lost volume and also fend off competition from Hong Kong Exchange. What's your view on the current situation? Do you feel that SGX can continue to grow? Comment below and let us know. Apart from SGX, you can also take a look at our dividend stock guide. We include 5 dividend stocks that might be of interest to you. Just click on the link on our show notes to download it. Anyway, that's it from me. My name is Stanley. Till we meet again, invest safely. Hi guys, thanks for watching the video. If you like it, please give us a like. And if you find it useful, I hope you share it as well. Remember to subscribe to our channel and click on the bell button to get notified on the next video. I'll see you in the next one. Bye!